Hello guys, welcome to the another interesting tutorial. And in this tutorial we're gonna learn about the fundamentals of accounting. Okay, so here in this fundamental of accounting, I have a case study of a small coffee shop, and I will try to give you a step-by-step guide in the world of accounting, going through this case study and this coffee shop, how does it maintains its daily activities. Okay, and we will try to learn all the fundamentals of accounting. Okay, so the most important basic fundamental, this is the index of what we're gonna learn. We will be okay. Let me just point one by step. First one is we're gonna learn about single entry system. Then we're gonna learn about the master key, that is the accounting equation. Then we're gonna learn about the accounting, the language of recording, that is the double entry system, and we will go on understanding some concepts like accrual versus the cash system. Then we have the three essential scorecard, like we have a income statement or profit and loss statement, or we have a balance sheet. Then we also have a uh, the cash flow statement. Okay, so then we will also learn about the matching trick. Then more like moving further in the age of AI, we'll also learn. Obviously there are also AI and automation is being used by in modern accounting for recording all those business entries. Okay, so this is the thing, this is the overall overview that we are going to do in this tutorial. So without wasting any time, let's start with this fundamental concept of single entry system. So in a very simple coffee shop, you can see this is a simple basic example of a week example. Okay, so in this single we are just taking a case study of a coffee house named the Daily Grind. Okay, okay, so this, as you can see here in the image, you can see a single entry cash book of the first week. Okay, week one. And what is the most important thing about this single entry cash book is you need to obviously enter the date in which the entry was registered, the business entry was registered, then the description, what exactly is entry about, like is it you're doing making some sales, or are you just paying to your inventory, okay, or are you paying the bills, what it is. Okay, you need to add the description, that, and whatever every expenses, like every business entry will be a cash in or cash out. Okay, so that means you will either you will do the payment, or either you will receive the income. Okay, so this is the thing, this is the idea. So you have a cash in, that is receipts or incomes, then you have a cash out, that is payments or expenses. Then finally you will calculate the running balance. So this is a very simple example of a cash book statement, a real life example how the coffee shop handles its daily business activities. Okay, the daily business entries. So this is it for a 1 week. As you can see here, it has many expenses, and also like rent. It also has a coffee sales, coffee and pastry sales. Okay, so in which how it is going to earn the income, right? So this is it. And then how it is going to analyze the health, by looking at this single entry. How can we analyze the health of the business is by simply adding up all the cash in. We know how much income, how much cash did we make in this week, and by adding up all the cash outs, we will learn how much cash did we spend. Okay, and then finally we will calculate the final balance, right, for that week. So this is how it is maintained. But there are some limitations, as you can see here. For example, let's suppose that this coffee shop wants to buy a new espresso machine, right, in credit. Obviously your assets is increased, right? You have a new coffee machine because you buy a new coffee machine, but you buy it in a loan, so that means you have to also record the liability. So here the limitation of this single entry system is you don't have any way how to show that, right? You there is no as you can see here, there is nothing this single entry cash book does not tell you that what kind of loan did you take or what kind of assets do you have. So these are the limitation of the single entry bookkeeping system. Okay. Okay, obviously these are the limitations, but we will answer those limitations with another other bookkeeping system like a double entry bookkeeping system. We will be talking about that. But like balance sheet, where it's gonna we are gonna talk about that. Okay, but first for that, to understand and know more about that, so let's learn about the accounting equation. So this is the master key. Okay, so what is this accounting equation? Okay, as you can see here, assets, the accounting equation, the formula is assets equals to liability plus owner's equity. So what is assets? Assets is what the business owns. Okay, what I have, what the business has, like a cash, equipment, inventory, okay, whatever things that they have. Okay, the physical things that they have like cash, okay, and equals to liabilities, that is what the business owns. Like for example, the business buy uh, a new coffee machine. The new coffee machine is the asset, whatever, but he buys that coffee machine in a loan, so he has to pay the loan, so that is the liability. Okay, and the credit, all the creditors that you need to pay. Okay, these are the liabilities. And finally the owner's equity, that is the claims after paying the liability, that is owns the owner's own claim. Okay, so whatever that the owner put in this business, that's his own money. Okay, it's like the owner's equity. Okay, so this is the simple explanation of accounting equation. Why it is important? Because it's the backbone of double entry accounting. Every transactions must keep their equation balance. Okay, what problems does it solve? It ensures accuracy in financial records and prevent the errors. Okay, why it is, where is it used? It is used in bookkeeping and like for example balance sheet that we're gonna use later on. Okay. Okay, so how can we apply in the practice? Because we can apply this in practice, this accounting equation in balance sheet, income statement. Okay, using this accounting equation, like, okay. So okay, now let's understand about the language of recording. Double entry. Double entry accounting means every transaction affects two accounts. One is debit, another is credit. Okay, so accounting isn't just a list, it's a two system of two. Okay, so that means whenever you where the expenses occurred, you don't make a list. Okay, like in accounting, in a business, it's not just a list. Okay, you buy a coffee, you buy a machine, you buy a coffee machine, you buy coffee beans, okay, you buy pastries, okay, all these things, and you sell the coffee, right? You sell pastries. All these things are not a simple list. Okay, they are the two-way system. Okay, so there, like as you see, as the statement says, that every action has equal and opposite reaction. So there is a system of two, that is a debit and credit. Okay, so this is the thing we have to understand, that we have to always keep the accounting equation balance and ensure the accuracy. Okay, why do we do that? Because it solves the problem. Okay, so to prevent income, what problems it solve is like it prevents incomplete record and errors. Okay, so so every transaction has, you have to understand that every transaction has two accounts. One is the debitors account and another is a creditors account. Okay, so to remember, you can use this debt principle mnemonics, like a debit expenses, assets and dividends to like assets and dividends to increase them. Okay, so obviously as I told you, double entry system is used worldwide in all bookkeeping system. Okay, so This is a simple example of a double entry system used by our coffee shop. Okay, so here we have a data, then account debited, like whenever like you then like you make a sales, okay, cash, so you get cash of 450, then your sales revenue increased, right? And whenever you have like you paid electricity bills, you have a utility expenses, then you just have to add it both in the account debited and account credited. Okay, so sales revenue here is a cash, is account debited. Okay, so no, utility expenses account debited, and cash is account credited. Okay, so you paid the electricity bills. Okay, so you have so this is how you make a double entry system, like. Okay, uh, okay, so let's move before moving further about all those these three important essential statements that I was talking about. Let's understand this very simple concept of accrual versus cash accounting system. So in cash accounting system, you record the money whenever you have this cash in your hand. Okay, so this is the most important concept that you have to understand. And in cash accounting, you have to you record the money whenever you touch the cash is in your hand. But in accrual accounting system, you record the revenue whenever you earn it, like whenever you deliver the product, you sell the product. For example, you sell a t-shirt in a credit. That means you have not received the cash. Okay, but you have already delivered it. Okay, so that means you have already sold it. You sold it in credit. In accrual system, you have to record that revenue. Okay, so like big companies like Apple use this accrual system whenever they record a sale. uh, like they just register that. Okay, uh, why they do that? For the smooth earning, and like smooth out their earning and provide an accurate picture of the real health. Okay, so now without wasting any time, let's understand these three fundamental core concepts. Like the first one is the income statement. What is this income statement? You need to understand why this income statement is necessary in your business. Okay, what why it is necessary to have the income statement, okay, in a company. Okay, like why they do that, why so the basic question is this one. So the income statement, it acts like a scorecard. Okay, how much income that you earn. Like for example, Apple uses this to analyze if their revenue growth is coming from selling more iPhone or just charging higher prices. Okay, so an income statement, it's also known as a profit and loss statement, reports a company's financial performance over a specific period of time. Like just understand, financial performance over a specific period of a time. Unlike a balance sheet, which is a snapshot in time, the income statement shows the flow of revenues and expenses. Okay, so here is the simple income statement of our coffee shop. So what is happening is you have a revenue of 3,800, and you have the expenses like wage, utility, rent. The total expenses is 1,220. Okay, so then your net income is all deducting the revenue minus the expenses, that is 2,580. Here, as you can check it out, we did not add the inventory. We did not add the inventory of 250 because 250 spent on the coffee beans is not listed here in this scenario, because those beans are assumed to be still in a inventory as an asset. Okay, that's why. So how this connects to the double entry system? So uh, this statement, the income statement, is a direct summary of the revenue and expenses account that were tracked in a double entry system, as you can see here. Okay, so the revenue, all credits in the journal, that is totals to 380, and expenses, all debits in the journal, total one. Okay, here like you can see all debits and all credits, as you can see here in the double entry system. If you can check out all the debits and all the credits, you will get um, the net income, right? So as you can see here, the net income, you get like dollar 2330. This is the exact figure that was carried over in the balance sheet to let's check out the balance sheet. Okay, we need to increase the owner's equity, ensuring that entire system remains perfectly balanced. Okay, so now let's uh, take over, carry this to the balance statement. So okay, first, this is the balance statement, but let's understand what is the balance statement. As you can see here in the statement, balance statement is the snapshot, okay, is a freeze frame of what a company owes and owes at a single moment. Okay, so as of January, as you can see in the time. Okay, the balance sheet itself is a final product of a double entry system, a snapshot that visually demonstrates the fundamental accounting equation that we learned before, is assets equals to liabilities plus equity. Every double entry transaction is designed to keep the equation in balance. Okay, so this is a simple balance sheet of our coffee shop. What is happening here is you have the assets, the liabilities, okay, so and the owner's equity here. Okay, so assets, the total assets you have is the cash, you have from all the revenues that you earned, plus the inventory, and the total assets equals to 3880. Whereas in the liabilities you have the all the accounts, you don't have any account payable, you didn't took any loan here. Okay, but you have the starting capital of 1500, and then you added the net profit, the correct one is 2580, and the owner's drawing, that is owners just took, as you can check here, owners drawing is owner's drawing, he took for the personal use, right? Here you also add that, and the total owner's equity is 3880, as you can see here. So the total assets balance the total liabilities and equity. Okay, so this is how the double entry ensures the balance. Okay, and also it also shows that every transaction has a dual effect. So when cash increase, assets debited, revenue increase, equity increase through profit credit. So this is for the sale. Okay, and for the expenses, like is when the cash will decrease. The when you make a sale, you the cash is increase, and when you make a way, like expenses, your cash is decrease. Obviously this is a simple it's very simple, right? And finally, the cash flow statement is the reality check. A company can show a profit but still go broke if they have no cash. This statement tracks cash from operation, selling stocks, investing, buying gear, and financial borrowing money. A cash flow statement deals the flow of cash through a business, categorized into three main activities like operating cash, investing cash, and financial cash. Okay, it reconciles the income statement and balance sheet data to show how the starting cash balance arrived at the ending cash balance. Okay, here's a cash flow statement for the our coffee house, coffee shop, and The cash flow statements have a operating cash flow from the operating activities, cash flow from the investing activities, cash flow from the financing activities, like owners draw the cash. This is from the activities, financing activities, investing activities, like no investment is done. Operating activities, cash received from the customer like 3,800, cash paid to supplies inventory 250, right? Cash paid for employees wages 300, cash paid for utilities 200, cash paid for the rent 800. Like in it, cash from the operating activities is 2330. Okay, and then cash from the financial activities 200. So net increase in cash from the week, so in the beginning of the cash balance was January 1st was 1500. Net increase in the cash from the week is 2130, and final cash ending balance is 3630. Okay, so this is the final cash balance. So this uh, is about the cash flow statement. It gives you the flow of the cash. Okay, so to check the final ending cash balance, 3630 matches the cash amount listed in the balance sheet. Okay, this provides the accuracy of the double entry system, like ending cash balance equals to the you can see the cash in hand here. Okay, I mean like the current asset cash here. So for the cash flow statement, operating activities focus on the daily core business transaction like sales, paying suppliers or employees, rent, utilities, whereas for the investing activities involves long-term assets such as buying or selling property or equipment, and financial activities relate to how the business is funded, including owner's capital, loans or drawings. Okay, this is for the financial activities, financing activities. Okay, so okay, now let's understand about the matching trick. The matching principle, the concept is you must record the expenses for the fairness of accounting. You need to follow this matching principle, like you must record the expenses used to make a sale in the same period you record the sale. Okay, for example, if you pay for a material in December to sell a toy in January, you wait until January to record the cost of goods sold, so cost matches the revenue. As I told you, the some final in modern accounting, AI and automation is obviously being used. Like tools like robot process automation (RPA) now handles the boring stuff like entering invoices or reconciling bank statements much faster and more accurate than humans. Artificial intelligence is also used. Like systems can now read thousands of contracts to find error or detect patterns or fraud that a human might miss. Okay, so finally you can think accounting is like a GoPro camera for your business. The accounting equation is the camera's frame, it holds everything together. Double entry is the lens, it ensures you see the action from two angles, so nothing is missed. The financial statements are the highlight reel that tells the world if the business won or lost the game. Okay, so this is very important. And hope everything is clear, guys. If you have any question, you can just comment me down. And this is a very important fundamental concepts for accounting. Hope this is gonna make the concept clear, and thank you, guys.